Hello and welcome to People and Profit, the show where we look at how business shapes our lives. Coming up, for better or for worse, is Britain heading for an EU divorce? The Brexit debate heats up among British businesses. We're putting the nuclear industry in the spotlight as the French government looks to reboot the state-owned giant Arriva. Plus, too much tech too soon. We look at the dangers of China's startup scene overheating. We're going to start, though, with the future of the UK in Europe. The British government has outlined plans to hold a referendum on Britain's membership of the European Union by the end of 2017. It sets the scene for a heated debate, and business leaders have already been weighing in on the issues. In a moment, we'll look at what the uncertainty may mean for the wider UK economy, but we're starting by taking the temperature of British businesses. Catherine Clifford has more.
As he steps up his campaign to renegotiate Britain's membership of the European Union, David Cameron has admitted he may face an uphill battle. After a recent summit in Riga, he said he hadn't found a wall of love from other EU leaders.
It's not going to be easy. These are difficult problems we're grappling with. Britain is not happy. I'm not happy with the concept of ever closer union. It's not really what we joined or signed up for, so let's sort that out.
As battle lines are drawn in Brussels, businesses are joining in the Brexit debate. Planemaker Airbus says it could reconsider its investments in the UK were the country to leave the EU.
Look for a competitive, stable economic environment to operate in, and we're a successful, integrated European company.
Deutsche Bank and carmaker Nissan are among the other foreign companies to signal they could think again about their British presence. Also, CEOs of homegrown Vodafone and EasyJet say they would want the UK to remain part of the Union. Heavy equipment maker GCB is on the other side of the argument. Its chief executive says British businesses need less red tape. Speaking to The Guardian, he played down the effects of a Brexit, saying the EU and Britain would continue trading regardless. The Bank of England says it will be researching the consequences of a potential Brexit. Many will be looking to the central bank to act as an arbiter, but they're going to have to wait for now. The bank says it will hang on till an appropriate time to release its findings.
Let's get more now on the economics of a Brexit, and we can turn to David Page. He's senior economist at AXA Investment Managers, and he's joining us from London. Thank you very much indeed, David, for being with us.
It's a pleasure.
Let's start then with the issue at hand. The British government says that there will be a referendum by the end of 2017, which means that we're now looking at more than 2 years of uncertainty, but by the looks of things. What is that uncertainty going to mean for the British economy?
Well, we think it acts as a headwind to economic activity over the next 2.5 years. I mean, there are a number of different channels that this could come through, but firstly we consider foreign direct investment. I think if you're a foreign company looking to set up plant in the UK, particularly for manufactured goods, there's a lot of uncertainty about what access you would have to the EU after a potential Brexit.
Now, so far it seems that more businesses have come out in favour of Britain staying in the European Union than the opposite. Do you think that's a fair assessment, and will that situation remain?
Yeah, I think it will for business. Certainly the CBI, the Confederation of British Industry, has been warning for some time since Prime Minister Cameron first mentioned the possibility of an EU referendum, that the majority of its members were against it. And that's true for the nation as a whole. It's particularly true for London. If we look at the London British Chamber of Commerce survey that came out just before the election, around 3/4 of the members there said that they were against the EU referendum, were for staying in the EU. So I think that's absolutely right, that from a business perspective, the majority are against it. There are some, obviously, that see the possibility of Brexit as an opportunity, but the majority, I think, are squarely against it.
Do you think that there are sectors of the UK economy that could actually benefit from Britain leaving the EU?
Yes, potentially. I mean, one of the benefits that the UK could see is the opportunity to negotiate individual bilateral trade negotiations outside of the sort of slow-moving and sometimes seemingly encumbrant EU infrastructure. So it's possible that for some firms there could be a benefit. But I think, when we think about the UK as a whole and the interrelatedness that we see with the EU, and particularly when we consider financial services, it's unlikely that it's going to be a benefit for the UK as a whole.
Now, to a certain extent, the focus is shifting to the Bank of England because the Bank of England has said that it will be assessing what a potential Brexit could mean to the UK economy. What do you think that the Bank of England will be looking at in its assessment?
Specifically, what I think they'll be looking at is various different measures of looking at potential relocations of EU operations. They'll be looking at changes in financial regulations that could come about. They'll be looking at the possibility of financial institution relocation. They'll probably be looking at some potential for capital flight, and maybe even looking at what they would see happening to sterling.
All right, David Page from AXA Investment Managers in London, thank you very much indeed for being with us. We're going to move on now. The future of the French state-owned nuclear firm Arriva is in the balance. It's been bleeding cash and the French government is looking to reboot the ailing company. Arriva has been dogged by a downturn in the nuclear market after the Fukushima disaster, but its troubles go deeper than that, as Olivia Zalazar-Winspear explains.
Looking for a knight in shining armour, or at the very least a generous bailout. French nuclear firm Arriva could be getting a helping hand from EDF. France's state-run power provider has mooted an ambitious takeover of Arriva's nuclear reactor business, an offer that's estimated at some €2 billion.
It's clear that Arriva is in trouble. It's important to keep the expertise, because it's an excellent part of France's nuclear industry. What we're suggesting is a way to preserve that expertise, develop it, and take back some of the market share.
EDF's bid would affect some 15,000 employees in its nuclear reactor division, a third of its global workforce, accounting for 37% of its annual sales. EDF isn't alone. Engie, the company formerly known as Gaz de France Suez, is interested in a stake in Arriva's servicing and maintenance unit. Chinese investors could chip in too, with the country's CNNC and CGN nuclear constructors reportedly looking into investing as well. If these deals take shape, Arriva would retain control of uranium mining, fuel treatment and decommissioning. The ailing nuclear engineer suffered losses of €4.8 billion in 2014, prompting plans to cut between 5,000 and 6,000 jobs worldwide. Problems attributed to costly new generation reactors and serious delays on the construction of a new plant in Finland. It's gone 3 times over budget, costing Arriva billions. EDF wants guarantees that the project will be completed soon with minimal overspending. The nuclear sector has suffered since the 2011 Fukushima disaster in Japan, with interest in reactors dwindling, and the plummeting price of renewables means nuclear's got competition. Experts estimate that Arriva needs a total of €7 billion in refinancing, which could force it to raise funds by selling off its assets piece by piece.
So, is the entire nuclear power industry running out of steam? Stephen Carroll is here now for a closer look at the state of things. Stephen.
Marcus, the Fukushima disaster in 2011 sealed the fate of nuclear power for some countries. Japan has yet to restart any of its nuclear plants. Germany went even further. It's pledged to phase out nuclear power by 2022. On top of that, 8 EU countries signed a declaration saying they'd commit to staying nuclear-free. More widely, use of nuclear power also appears to be falling. The International Atomic Energy Agency says that electricity generated from nuclear power fell by around 8% in the past 4 years, or 219 terawatt hours. That's more than the electricity that Australia consumes in a whole year. There were also 3 fewer nuclear reactors operating in 2014 than 4 years before. Overall, there are 67 new reactors being built around the world, but as we've seen with some of Arriva's new projects, that doesn't mean they're going to open anytime soon. Of those 67, 49 are experiencing significant delays in construction. 8 have been delayed for more than 20 years. All of this has led to companies like Siemens quitting the nuclear industry. The international players that remain include Arriva, Russia's Rosatom, South Korea's KEPCO and China's National Nuclear Power Corporation. They're all majority owned by the governments in their countries. With oil prices as low as they are, the government subsidy has become even more important at keeping those businesses alive.
All right, thank you very much indeed, Stephen Carroll, for that look at the global nuclear industry. Next up, we're looking at China's startup scene. Companies like Alibaba, Baidu and Tencent have become global success stories, and they've inspired young tech entrepreneurs in China to try their own luck. Authorities are trying to encourage the trend as they're looking to diversify the Chinese economy away from manufacturing. But there are warnings that the tech sector in China is becoming too crowded, as our correspondents Paul James and Clémence Dibou found.
Every morning, Ting Ting starts her day by checking her mobile device to figure out just how many people have joined her app. 4 months ago, the young Chinese girl quit her job as a finance analyst to develop an app which is specifically designed to help small-scale shop owners promote their shops on the internet.
So they could leverage our app to connect with customers to sell products. So young people get bored of working in big companies, so they really want to do business on their own.
In only 3 months, Ting Ting was able to get an investor to back her initiative in Shanghai. Her backers feel she may be able to become the next Alibaba or Tencent, which are the internet giants currently dominating the Chinese internet market.
We provide actually housing and help with accounting, legal setup. We invest also another $30,000 to $50,000 cash, and in return we get 5 to 7% of the company.
With some 700 million internet users in China, the potential is huge. The Chinese government has been actively promoting people like Ting Ting through tax cuts and other incentives. Authorities in Beijing pumping in 53 billion euros worth of money this past year, which some observers are suggesting may be a bit too much.
If the sector still goes on like that, in 5 years or more, there is the risk of a bubble. Everybody wants to invest on the internet. New enterprises attract lots of money from more and more investors. But most of these companies will disappear. Only few of them will survive. The risk of a bubble is very real.
Even though the Chinese economy overall is on the downturn, authorities in Shanghai are still hoping that 200,000 entrepreneurs will be in the city by 2020.
With that, we're going to be wrapping up this edition of People and Profit. If you want to get in touch, go to our Facebook page, France 24 Business. You can also tweet me on @MarcusF24. Thank you for watching and see you next time.